Oh, it's time. It's time for Freightonomics. Freightonomics, welcome to the show/podcast, depending on how you are viewing/listening, where we combine the freight market data with the macroeconomic environment and squish it together. I am Zach Strickland, head of Freight Market Intelligence. Anthony Smith, chief economist here at FreightWaves. And today we have got a big show because the illustrious Dr. Zac Rogers is joining us to give us an update on the LMI in July. It rhymes, that's why I said it, Anthony.
I just found out that I was really causing some havoc in production and my mic was off, but I'm excited to join the show now. But yes, LMI in July, so we'll have Dr. Zac Rogers on in just a few moments. Also, I'm going to be watching FreightWaves LinkedIn from time to time. So if you want to join in, be a part of the show, welcome to any questions for ourselves or Dr. Zac Rogers, any topics throughout the show, be a part of the show. I'll also even do a step further and watch YouTube and maybe Facebook as well. So join in on the show, leave your comments and anything like that. Get Zach canceled, whatever it might be.
Meta, is it Facebook still? Yeah, and I want to bring, obviously I want to get to Dr. Rogers quickly, Anthony. So let's go ahead and give a market in two, if you want to count me in.
And 3, 2, 1, go.
All right, the OTVI leads us off once again. This is the headline figure of the month of July. Now that we're in August, still a headline figure. OTVI starting to trickle down a little bit, but doesn't erase the fact that what happened. Tender volumes did increase 5 to 6% in the month of July, and it trended higher there for a minute. It's starting to trickle back down. I don't take too much out of this. It's not a strong drop or anything, and that's actually a decent sign that this has some legs under it, a little sustainability. It will be something to monitor moving forward. I don't know that this is the inflection point that we were looking for in the overall market. There are some signs that this may be transitory as we move into the end of the third quarter, and the fourth quarter might be a little pull forward here. We'll see. Dr. Rogers may give us a little insight here as well. Moving into the next one. The tender rejection rates, capacity does not care. Tender rejection rates still under 4%. Tender volumes increased. Normally, what we would have seen would be a big spike in tender rejections with that level of a demand side increase. Did not happen here. So arguably, people may not even know that this demand side increase is happening because capacity is able to gobble it up exquisitely. Let's move to the next one here and look at the tender rejection rates in Phoenix and Los Angeles. So this is an area of the country that is feeling the crunch here. Tender rejection rates increasing over 4% in Los Angeles. They've been ticking higher since April. And in the Phoenix market, we just had a huge spike. So I want to show you the spot rates out of Phoenix because these two markets have been relatively active this summer, and it's a little unusual. Let's move to the next one here and look at spot rates from Phoenix to Dallas. Spot rates there in green, contract rates in purple, spot rates above the contract rates going from Phoenix to Dallas. Let's look at the reverse lane real quick. Spot rates dropping from Dallas into Phoenix, unheard of. Exact opposite trend going inbound. So Phoenix market, dude, traditionally an extremely oversupplied market is on the verge of flipping as we've seen significant warehouse growth out there in the desert.
That warehouse aspect definitely going to be a big thing that we're going to be chatting with Dr. Zac Rogers about in just a few moments. But Zach, we got to talk about, of course, the rise in volumes overall. And now we're starting to see those somewhat of a retreat, but really overall throughout the entire period, essentially what we got from rejections is just like a cool story, bro.
Yeah, man.
Just a sign that, hey, there's just so much supply on the market or capacity on the market that really what we would need to see is more or lessening in the overall supply of transportation in order to have any kind of meaningful increase in rates.
Yeah, it doesn't seem to be mattering outside of the West Coast where we've seen Los Angeles return. And these rates are up compared to where they were a few months ago. This is by no means like the market is collapsing out west. Those trend lines were only 6-month trend lines coming out of Phoenix. And it's like a slight bounce, off of a bottom. And it's happening there faster than other places of the country. The rest of the country still just kind of like, meh, volume's not really mattering. But the West Coast is an intriguing development, if you will.
Yeah, big development. Also, a quick shout out to people on LinkedIn. Thanks for commenting so far. Luis, thank you so much. Martinez, Danielle and Krista, shout out from Los Angeles, AFL. So thank you guys for tuning in. Appreciate the participation.
Yeah, and I wanted to mention before we get to Dr. Rogers, we had some earnings. C.H. Robinson, CEO Bozeman, makes earnings call debut after tough Q2. I don't think there were any surprises here from the nation's largest brokerage. Total revenues declined to $3 billion in the second quarter, down from $3.3 billion in the first. And of course, their shipment count was their shipments per day were actually up from the North American surface transportation to 15%. They were up 15%, and that's meaning they're doing more, making less. And this is not unusual in this market. You're talking about getting a volume play. Traditionally, C.H. Robin is a volume play, market share grab. They want to get a lot of activity going through their system. That's how they make their money. And they're sacrificing margin at the same time. And of course, a lot of those figures showed pretty, they're still making money.
Yeah.
So it's not the worst case scenario, but they are going sequentially lower. I think this tells us that, number one, the second quarter was kind of what we thought.
Yeah.
Wasn't great. The market's still in decline.
And also an interesting time for, of course, new leadership to be on board. Just like, all right, I am here, and here's the situation.
Well, he can always, it's easy in these transitional states. It's like, well, it was their fault.
Yeah.
But at the same time, it's the market's fault, guy. I mean, this isn't, yes, there may be some operational efficiencies. I know that the ownership wanted some new direction at this point, and I understand that, but it's too early to tell. This isn't obviously his doing. It's not his undoing. It's he's got a market that he's inherited. He's got a company that he's inherited that I can't tell if there's any change or not.
So knowing that, because I think, it's spot on, especially whenever you're in there's a new role or something going on, you can always blame, hey, it was the last guy's fault. But now I think he's going to be on the clock. How long do you think until people start getting a little bit restless for results?
I think it largely depends on what his competition does.
Yeah.
If they start outperforming him, then that's when we'll know.
Yeah.
And that, it's obviously he's been there for a quarter. So, I mean, that's time will tell on that one. I think he's got a year at least before we're going to start to see those comps make a difference.
Right. That makes a lot of sense. And I mean, like you said, this is definitely a transitionary time and an interesting market to kind of jump into. And also, Zach, do we bring in?
Let's do it. Let's bring him on. I want to get to the meat of the show right here. Dr. Rogers, thank you once again for joining us. I know your time with us was cut short last time, unfortunately, and we didn't get to finish it. So I want to cram as much Dr. Rogers into this show as I can.
I'm just kidding. I'm fine. Okay, so LMI in July, we should have made shirts. But Zach, what you're saying about the second half of July is absolutely what we saw in the LMI this month. For those longtime listeners, they don't need to for me to re-explain this. But if it's your first time, the way the LMI works is we go out and we ask a whole bunch of folks, transportation, warehousing, inventory metrics. Are they contracting? And if they're contracting, we'll see a number below 50. Are they expanding? If they're expanding, we'll see a number above 50. And we break these down in a bunch of different ways. And one of the things, it was actually the chart we put right up at the top of the report this month because I thought it was so interesting, is early versus late July. Because essentially what we did is we broke down our respondents, the 1st to the 17th, which I chose because it's halfway and my mom's birthday, so 17th, and then 18th to the 31st. That was the other side. And what we saw there for transportation, I thought was really telling. So transportation utilization and transportation prices both moved up by 11.5 points in the second half of July. Now, they were both still contracting. Okay, so transportation utilization came in around 48.9, about 49. Transportation prices were at 42. So that's still contraction, but it's much lighter contraction than what we saw in the first half of July when they were both down in the 30s, which is really a fast rate of contraction. And I think it's interesting. And the real reason I picked the 17th is because that's right around the time where it really started to look like, hey, maybe yellow is in big trouble and not coming back from this. And so we saw a lot of folks kind of shifting, shifting tenders over to other alternatives. And I think we're finally starting to see equilibrium, not actual equilibrium yet, but a move towards equilibrium in the freight market. I mean, what we've been saying, both us and you guys for the last year, and a year, by the way, is how long transportation prices have been contracting. The first contraction we saw is July 2022, and now we're at July 2023. They've been contracting for a whole year, and what we've been saying is, well, there needs to be a rebalancing in the market. Until we see some capacity exit, we're not going to see prices come down. And capacity has been a little slower to exit, I think, than any of us anticipated. In hindsight, it makes sense because so many people had giant cash reserves after just an awesome year in late 2020 and through most of 2021. But now we are starting to see some movement. That doesn't mean that prices are going up everywhere other than Phoenix, which is now the warehouse capital of the West Coast. But we are moving towards, I think, some balance in the market, and it's really interesting. I broke out a graph for my friends at DC Velocity yesterday, and one of the things I showed was late July, early July is the mirror image of March 2022. So in March 2022, we had a 91 in the first half of March, and then suddenly we dropped down to like a 79 or something like that. This month we had, and this for transportation price, this month we had a 31, jumped up to 42. And so we saw that same really sharp movement in late July versus early July that we did in early March 22, late March 2022, which I think a lot of us would define as sort of the beginning of the slide in the freight market. So, we have rebalancing on capacity, probably to thank for that. Maybe Taylor Swift injecting $5 million into the freight economy too. I don't know how big a deal that was. But both those things, I think, say maybe it's not the inflection point, but it looks a lot like the inflection point did when we were going back the other way 17 months ago.
And Dr. Zac Rogers, one of the big things, of course, that was just mentioned there was, of course, all the warehousing activity going on in Arizona. Can you tell us about some of the aspects of inventory levels and what's going on with warehousing? Because this seems like a really interesting situation right now.
It's really interesting. We're seeing such a split between our upstream and downstream firms. If you just looked at the overall inventory number for this month, it was 41. I think 41.9, which is actually the lowest number we've ever had. So that's the fastest rate of contraction we've ever seen for inventory levels happened this month. When you break that out, you see that upstream firms, so this would be manufacturers, wholesalers, we're to 37. Downstream firms, so retailers, anybody who's consumer facing, was at a 51.5. And so we are seeing some things, growing. And mostly what we're seeing right now is like stuff for back to school, some sort of consumer-y stuff. And then, of course, there's a ton of factory construction going on right now, which I guess I think is because of the legislation that was passed last year. But Phoenix specifically is going to be more impacted by this downstream inventory levels than they would upstream. And the reason for that is because a lot of if you go around the 303 loop where they're putting a ton of stuff in, a lot of it is e-commerce. And okay, we kind of ran out of space in the Inland Empire, so we're going to bring it into Phoenix and ship out a bunch of e-commerce and things like that. And that's sort of turned into a regional distribution up to the West Coast. So we have some inventory growth in part of the economy, no growth in other parts. What does that do to warehousing? Well, we see the same sort of dynamics in warehousing where prices are much higher downstream than they are upstream. And what's funny, though, is capacity is still really big downstream. So we have this weird dynamic right now where we have capacity coming online in warehousing, which I thought at this point that we would really kind of be stepping on the brakes with warehousing, but we're still building stuff all over the place, and prices are still going up. And a lot of that is because the warehouses that are being built, a lot are for e-commerce, and so they're in expensive areas of the world. And then also we just see a lot of construction for manufacturing. And so we have all these semiconductor stuff going on and high capacity batteries and electric cars, and there's huge supply networks that come in underneath it. And so we're seeing a lot of high tech warehouses, a lot of warehouse in expensive areas come online. And so we're really seeing resilience in the warehousing market that we certainly didn't see in transportation. And despite inventories being still pretty low, warehousing, even though it's softened, is still showing growth across all of our metrics.
Yeah, and thanks for the shout out to T-Swiz there. My daughter has actually reminded me that she's injected money into the economy. Of course, she's a huge fan.
She put 140. I went to the concert. I got an 11-year-old at my house, so It was kind of to her. And honestly, maybe the 38-year-old was at my house was also just as excited. My wife, but we went. She put $140 million into Denver a couple weeks ago. She may be the most successful economic policy of the Biden administration, I think, is Taylor Swift just going across the country.
And of course, shout out to her bonusing the truck drivers that are supporting her tour.
But a supply chain hero.
I want to talk about this divergence between upstream and downstream a little bit. Like the upstream, of course, wholesale, manufacturing, it appears to be a little bit more like poised to strike in terms of like overall activity, whereas the retail side has been, relatively, it's been softening the most because it drove a lot of the pandemic era activity. Right. Do you see anything there that makes you think that, well, maybe that lends credence to the fact that retail might have a softer impact this fourth quarter and the upstream side of things might get a little bit more active? Or do you think there's a switch of that?
I think we are poised for upstream. Like we mentioned, in addition to Taylor Swift, the other good economic policies are the CHIPS Act and inflation. And there's all this economic activity. And what's fascinating to me, that the one stat I thought was most interesting from this month's report was future upstream versus downstream for transportation capacity. So this is estimates from our upstream and downstream respondents for where will transportation capacity be in 12 months. And what we saw downstream, so this is the retail side, what we saw downstream was a 73.5, which means a lot of capacity coming online. Upstream, we saw 49.4. That means slight contraction, about even, but slight contraction. We haven't seen contraction in transportation capacity since the first 2 months of 2022. And suddenly upstream is saying, we actually think markets are going to get a little bit tighter moving forward. And I think that's because of two things. One, Yellow and third biggest LTL carrier in the country going out of business. That's obviously going to tighten capacity more on the upstream side than on the downstream side. But also, I think that we're seeing some momentum behind there's going to be growth. There's going to be activity upstream. Consumer confidence index is at 71. We're up 11 points from where we were a month ago and way up from where we were a year ago. Inflation seems to have calmed down. And we have all this stimulus now. If you think about what happened, and Zach, you're absolutely right. Retail drove the economy for so long because what were we doing? The government was putting stimulus into consumers. And so consumers were spending a bunch of money. That's pretty much dried up by now. And now what we have is stimulus into the industrial side. We're doing all of this work for manufacturing and infrastructure and all this stuff. And so I would expect us to see a similar bump upstream because of all this stimulus that we saw downstream in 2021. To me, it's sort of the same thing. Now, the trick would be, let's not overheat the economy again like crazy. But I don't think we will, because people won't spend money quite as crazy as it is when it's you and me. I think companies will be smarter about it. But it really, I think you're absolutely right. It seems to me that our upstream respondents, and their future LMI, by the way, is 2 points higher for the overall index than downstream. So it's across a couple categories. I think that we're going to see a little more tightness upstream, especially as we move forward into late 2023 and really in 2024.
And Zach, when we're looking at what's happening upstream, one of the things I think is intriguing about this, of course, is interest rates continue to be trending upwards as of now. Do you see this as a potential headwind as some companies look to invest in maybe infrastructure or more expansion overall in capital good expenditures?
Well, sure. There's a great example of that here. They're trying to work on the Eisenhower Tunnel, which goes over the mountains near Denver if you want to go skiing. And they had some money earmarked from it when infrastructure first got passed. And now it's like, well, that's actually not enough anymore because inflation has increased costs by so much. So we're going to need a little bit more money to do it. So you have a lot of, I think, situations like that. And look, interest rates have gone up like 11 times in the last year. I mean, when was the last time that happened? 1982, I guess. And so, of course, it's a shock. I do think, though, that a lot of that, the interest issues have passed us by now. It seems highly unlikely that we're going to have another 11 increases of the interest rate over the next year. I would imagine that we're through the worst of it. And so I think that firms are starting to be less hesitant because you're absolutely right, Anthony. People didn't want to put down a big investment or spend a lot of money if the interest rate might be a whole point higher in 4 months by the time a project actually gets off the ground. And so I think we did see a lot of caution. And of course, we'll see what happens with the Fed and if they want to keep going with this or not. It seems like they're going to slow down. The other thing I would say with that is aggregate logistics costs. So when we put all of our costs together, from transportation, warehousing, and inventories. When we look at it, they were a 156 this month, which 150 would be break even. So 156 is just barely growth, and that's down from 270 a year and a half ago. And if you look at the San Francisco Fed, they're doing really interesting work with breaking out the drivers of inflation. And one of the main drivers all last year was supply inflation. So supply costs were really, really high. We had shortages, inventory. We had way too much inventory. Warehouses were really tight. That's really been worked down now. And so even if we still see some, growth in consumer demand, which we continue to see growth in everything, I believe that because supply costs have come down by so much, that really blunts a lot of the impact that inflation had. And so I think people are optimistic that interest rates, maybe we're going to go up another 0.25, but at this point, it seems really unlikely that we're going to ever go up another full point, at least, in the next year or so.
So, you mentioned inventory levels and, of course, the polarizing responses from the upstream and downstream. Do you feel like the inventory situation has largely corrected? Are we back to a point where people are now ordering? I think the report actually mentioned that people have kind of abandoned this just-in-case almost entirely and are now kind of in this just-in-time mentality. Do you think that may actually provide a little bit of a boost here later in the year as people kind of are waiting to the last minute to place orders?
I do. If you look at TEUs coming into the Port of LA, scheduled for this week, we're up 54% from the same time last year. And so we are seeing it because at this time last year, there was no peak season. You remember that? That was fun. There was no, nothing came in because we already had way too much stuff.
Right.
We've worked it down now. And you know what? I'm pretty sure kids are still going back to school later this month. I'm also almost positive Christmas will be on December 25th. Like I'm pretty sure all these things are still going to happen this year.
We'll see.
And so it seems, and whatever other holidays you may celebrate, but they're all coming up. And so people are still going to be bringing stuff in. I mean, Target has corrected itself. Walmart, all the big guys have corrected themselves. And it's funny, if you look at big retailers versus small, or large versus small firms. So that's one of our new, I think it's new actually since last time we talked to you guys. We break our groups down into over 1,000 employees and less than 1,000 employees. The over 1,000 group inventory is right at 49. So it's pretty much, we have inventory just sort of here, but we're being very just in time with it, right? It's right at about 50. And so if inventory is right at about 50, it means some comes in, some goes, and we try to keep everything level. Now the small firms are at 37. And I think the small firms are being really cautious because of how badly they were burned a holiday 2021 and then through so much of 2022, and they may not be able to afford to overestimate again. But I think that firms are thinking, okay, we can go to JIT. Plus, we have so much slack now in the transportation markets that we can get things here quickly if we need to. It's not going to be like September of 2021 when there's 112 ships off the coast of Long Beach. We can get things over here quickly if we need to. Plus, I mean, it looks like it's going to be a big service spender anyway in Q4, I think. So there certainly is revenge spending and revenge travel and all that stuff. We're not going to have inventories as high as we did in 2021. There's no way we're doing that again for a couple years. But I do think that we will see inventories start to build up because we have absolutely corrected at this point. We swerved way in one direction when COVID happened, overcorrected the other way. I mean, it's like driving a car. You swerve to get out of the way of something, then you swerve too far back the other way. And now the swerves we're making are getting slower and slower. And pretty soon, I think we'll be going down the road nice and straight. Are we done already?
Rogers, we're already done. And we could have gone on for another hour or so, but thank you so much for joining us.
Drink more water.
Drink more water. And we'll see you all again next week.